1929, Wall Street crashes hard. Worse than a war, it wipes out millions of American savings. Even the smartest economists like Irving Fisher and John Maynard Keynes didn't see it coming. What caused this disaster? And could it happen again? Let's break it down. Hit like and subscribe to dive into this crazy piece of financial history. The 1920s were America's golden years. The economy was on fire. GDP jumped 42%, from $690 billion to about $977 billion. People were making an extra $1,500 a year on average, and unemployment was under 4%. Everyone felt like a winner. The stock market was where the action was. Teachers, cab drivers, even housekeepers were reportedly making millions buying stocks. Newspapers hyped it up like crazy. But when everyone's cashing in, trouble's usually around the corner. In March 1929, the market dipped 10%. Investors got margin calls, demands to pay up on loans they used to buy stocks. People freaked out. Big banks like JP Morgan said, "Chill, we'll keep lending." The market bounced back, and by summer, the Dow Jones was up 27% from the year before. Everyone thought the good times were here to stay. Spoiler, they weren't. Comment below, what would you have done in that market? Then, October 24th, 1929, Black Thursday, hit like a freight train. The Dow was already down 20% from its peak. That morning, stocks tanked fast. 150,000 shares of City Service, an oil company, were sold off for $8 million. Big names like RCA and Montgomery Ward lost 30 to 40% by noon. Investors were desperate, selling stocks to cover margin loans. Richard Whitney, a big shot from the New York Stock Exchange, and JP Morgan stepped in, buying 25,000 shares of U.S. Steel at high prices to calm things down. It worked for a day. By Monday, October 28th, the market crashed again. No one could stop it. Billions in wealth gone. The American dream shattered. So what went wrong? 3 big reasons. 1. Too much borrowing. About 40% of loans in America were for buying stocks. When the market crashed, people couldn't pay back those loans, so brokers sold their stocks, wiping out savings. 2. Ignoring the red flags. A huge scandal in London. Hatred groups collapsed after faking assets. Shook global markets in September 1929. Wall Street didn't care. Bad move. 3. The Fed screwed up. In 1928, the Federal Reserve raised interest rates to slow down stock market frenzy. Instead, it slowed the whole economy, causing a global ripple effect. In 2002, Fed official Ben Bernanke admitted, "Yeah, we helped cause the worst economic disaster in U.S. history." Think about it. Are we seeing any of these signs today? Drop your thoughts in the comments. The 1929 crash wasn't just about money. It was about greed, bad decisions, and ignoring warning signs. Honestly, looking at today's markets, I see some scary similarities. Crazy borrowing, wild optimism, and sudden rate hikes. It's like 1929 with better tech. Here's what I wonder. Have we learned anything, or are we just setting up for another crash? What do you think? Comment below, and if you're into these financial history lessons, hit subscribe and that bell icon. That's the story of a 1929 crash, a disaster that rocked America. If you like this breakdown, smash like, share it, and subscribe for more. Tell us in the comments, how do we avoid another crash like this? Catch you in the next one.